Good morning and welcome to today's webcast, 2024 Fall Accounting and Audit Update. Before we begin, I'm going to play a brief housekeeping video.
Welcome and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams, Etty Goldstein, Senior Manager, and Hilary Tanneberg, Senior Manager. With that, I'll turn it over to our presenters to get us started.
Thank you, Kiva. So hi, everyone. My name is Etty Goldstein. I'm a Senior Manager at Moss Adams, and I specialize in performing audits to nonprofit organizations. And I'm excited to be here today with you going over the Fall 2024 Not-for-Profit Accounting and Audit Update. So for our agenda today, we will cover audit and accounting updates, some updates on the uniform guidance, some GASB updates as well, and we will complete our discussion today going over cybersecurity. Our learning objectives for today, which are needed for CPE purposes, are to describe recent and new accounting guidance affecting not-for-profit organizations, describe the current state of cybersecurity and how to protect your organization, and an overview of GASB statements, currently effective and upcoming. So let's start with our first polling question, and I will pass it to Kiva.
This is the first of 4 polling questions. The question is, what type of organization are you? A, higher education, B, foundation, C, social welfare or charity, D, other. I'll give you a few moments to respond, and just as a reminder, to participate, please click the button next to the answer you choose and hit Submit. Looks like we have about 80% of people responded. We'll give it another moment here. Okay, and here are the results.
Oh, awesome. Oh, it seems that we have a good amount of different responses here. So at least we're glad to see a good representation for today's presentation. So with this, the first item that we're going to discuss today is the current expected credit loss, or as also known, CECL. And this is one of that last new accounting standards effective for nonprofit organizations. It became effective for fiscal years beginning after December 15, 2022. So I would expect that most, if not all, nonprofits are in the process of have already considered the impact of this standard on financial statements. And even though it mainly impacted financial institutions, it also had an impact on nonprofit organizations. And that's why we're talking about this one today. And this standard requires a change in the estimation of losses. So management is now required to estimate credit losses over the contractual life of the financial asset. So the consideration of historical losses is not sufficient anymore by itself. So let's go over what's in scope with this standard. Well, it will be contractual assets, loans receivables, including those programmatic loans, certain type of investments specifically related to hold to maturity debt securities. Also, it will be in scope for trade receivables and reinsurance receivables. So it seems that some other assets are missing from this list, right? Well, that is because for nonprofits, there are specific items that are excluded from the scope of this standard. This will be pledges receivables, like those promises to give, as they're governed by a different standard. All financial assets measured at fair value, like those investments that you typically see classified as level 1, 2, or 3 on the financial statements. Those operating lease receivable, and also known as the right of use assets, and any loans issued as part of the defined contribution plans. And lastly, any loans receivables between entities under common control. And we wanted to specifically go over some of the significant assets for nonprofit organizations, which in this case will be trade receivables. And under the current GAAP, these receivables typically don't have a reserve. It is common to see that these are considered fully collectible based on historical information. However, under the new standard, an allowance for credit losses is expected. But generally, nonprofits will need complicated modeling to develop forecasts. The discounted cash flow loss estimation methodology is generally not expected to be used, given the short-term nature of those trade receivables. And non-credit related adjustments like returns and discounts shouldn't be considered for CECL purposes. So in general, what we're trying to convey here, the message is, yes, historical information is very significant when you're looking at trade receivables, but under the current model, you are also required to look at those forecasts in order to determine if there is going to be an allowance for credit loss. And in general, we have shown so far there are several assets that are typically held by nonprofits where this standard is not applicable. So maybe you will be asking then, is this material for nonprofits? And in addition to those items out of scope from the standard, management could also potentially determine materiality or a threshold to assess where the standard is deemed to not have a significant impact. However, if management determine a threshold, they should also document that basis of why CECL doesn't have a material impact in the specific assets accounts, including the consideration of any omitted disclosures in those financial statements. So that information, you will need to consider if that information is missing or omitted from the financial statements, and how would that impact decisions that users make on those financial statements. And again, it's just very important that you have documented this assessment so it's easier to understand those requirements and how management is meeting the requirements of the new standard. It is also very common that when there is a pool of assets that have never experienced a credit loss, that the standard will require management to adjust that historical experience by, again, considering reasonable and supportable forecasts. And if their results indicate the same results, then an additional allowance will not be required. But you still need to go through the process of assessing those reasonable and supportable forecasts. And as shown here, there's a specific exception related to US securities, but this is not applicable to trade receivables as we just discussed in the previous slide, because this is a significant area for nonprofits and it no longer can be seen as looking at historical information by itself. So how does this impact disclosure specifically for nonprofit organizations? Well, the main changes for those disclosures would be that you will need to revisit and update the description of the policies and methodologies used to describe how management developed those reasonable and supportable forecasts. So we will also need to include a roll forward of the allowance for credit losses and a roll forward for loans receivable balances. And to wrap up this specific topic, we wanted to reiterate a few items that were learned so far. So it is crucial that management evaluates the quality of the information used to ensure that those forward-looking indicators are included in their assessment. Because again, looking at historical data wouldn't be sufficient in accordance with the new standard. Also, within the update process and policy, it is recommended to include how these assets will be monitored, as circumstances and forecasts could significantly change and originate a different result. So every year you'll have to reassess those forecast information in order to determine if the allowance for credit loss is still sufficient as of that point. And our next topic is cryptocurrency or crypto assets, which is not very common yet in some nonprofit organizations, but it does exist. And nonprofit organizations typically reach out to ask how this will be recognized. So under the current generally accepted accounting principles, crypto assets are generally accounted for as indefinite life intangible assets. And this account results in the initial measurement of that crypto asset at cost and subsequent impairment evaluation, which is also referred to as the cost less impairment model. Under this model, assets are required to be tested for impairment on an annual basis, or when circumstances indicate the current amount of the asset may not be recoverable. So the first step here is to understand that the asset must meet all of the criteria. So, and this is the criteria that we're showing right here on the slide. And these are going to be that these assets are to meet the definition of an intangible asset as defined by the codification. They do not provide the asset holder with enforceable rights or claims on underlying goods, services, or other assets. It also needs to be created or reside on a distributed ledger based on blockchain or similar technology. They also need to be secure through cryptography, to be fungible, and to not be created or issued by the reporting entity or its related parties. And these assets will be disclosed in the statement of financial position, separate from all other intangibles, and all gains and losses will be presented separate from the amortization and impairment of all other intangibles in the statement of activities. And for the statement of cash flow, this will classify as cash flow from crypto assets as operating activities unless they are received to finance capital. So what's changing? There has been some concern that the cost less impairment accounting model, which is the one that I just explained under the current GAAP, it doesn't reflect the underlying economics, or it doesn't provide the user of the financial statements with decision useful information, as the subsequent increases of these assets and the value of these crypto assets aren't reflected in the financial statements. So therefore, ASU 2023-08 was issued, and the amended guidance requires entities to measure crypto assets meeting the mentioned scope criteria at fair value in accordance with topic 820, which is the fair value measurement. And this will change the recognized in the net income at each reporting period. So this will still be presented separately from other intangible assets in the statement of financial position, and will require some additional disclosures to show how this fair value was determined. And this standard is going to be effective for fiscal years beginning after December 15, 2024. So it's coming up pretty quickly. And with this, I'm going to move forward to our next topic, which is the Uniform Guidance updates. But before we start, let's go over our second polling question. So, Kiva, can you please help us with this?
Yes, this is our second of 4 polling questions. The question is your organization subject to single audits? A, yes. B, no, but it will be subject to single audits in the near future. C, no. D, unsure. As a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. We'll leave this open for another moment. Okay, and here are the results.
Oh, fantastic. This is really good news, since we're going to go over the changes that are to happen on the compliance supplement. Okay, so for those nonprofits that have federal expenditures over the threshold and trigger what we call a single audit, there are finally changes coming up for the Uniform Guidance. I know you probably have heard a lot about these changes, so it's good that we're going over them again. This is going to be effective for fiscal years beginning after October 1st, 2024. So we still have some time to understand these new changes and how it's going to impact the financial statements and the information to be included in the CFA, and any other disclosures that need to be included due to these fundings. So these changes are expected to alleviate burden on recipients and subrecipients. It will make it easier for organizations to navigate and benefit from federal financial assistance opportunities. The revisions include clarification to the applicability of requirements and terminology for uniform guidance, and some relaxation and clarification to certain requirements that require prior approval from federal regulators. These changes will also replace areas of the guidance with more plain English to simplify the process of applying for and managing federal grants and contracts, as well as making those federal financial assistance more accessible. In turn, the federal government aimed to decrease burden on recipients and subrecipients of federal financial assistance. So some of these key changes include reduction of complexity and technical language throughout, including improved language for notices of funding opportunity, which are the NOFOs. It will also increase the audit threshold from $750,000 to $1 million. So that's one of the most significant changes here. It will also increase the equipment and unused supplies threshold from $5,000 to $10,000. It will also increase the emphasis on monitoring of federal funding accountability and Transparency Act reporting, which is the FFATA. And now for internal controls, it must include cybersecurity and other measures to safeguard the information. And this one is a particular very good change because it's going to help management document and understanding a little better how are they securing that data that's being reported through these different systems that different nonprofit organizations use to monitor these federal fundings as well. And some other changes that we wanted to show and just highlight for today's presentation are that this new compliance supplement will add veteran-owned businesses to the type of businesses recipients and sub-recipients are encouraged to consider on the federal awards. It will also clarify that corrective action plan does not need to be on a letterhead, which is typically one of the questions that we get every time there is a corrective action plan. So it's good that they are clarifying that. And also for entities with total federal expenditures under $34 million, the increase in the Type A threshold that's typically used or that it's actually used to determine major programs, it's going to be updated to 1 million. And it also increased the threshold for the Type B programs that require risk assessment to $250,000. It also increased the minimum indirect cost rate from 10% to 15%, and the exclusion of sub-award cost in the modified total direct cost calculation used for that the minimum indirect cost rate, and certain other rates were also increased from $25,000 to $50,000. So overall, there are a lot of improvements in this area coming up soon, and you can check the complete list of all changes within the 2024 compliance supplement issued by the OMB, which is the Office of Management and Budget, because there are some additional clarifications included on the compliance supplement, and these are the ones that we showed today are the most significant ones. So now, in order to go through our next topic, which is GASB updates, I'm going to turn it over to Hilary.
Great. Thank you, everyone, for joining us today. Hilary Tanneberg, Senior Manager with Moss Adams, working primarily with not-for-profit organizations, higher education institutions, with a focus in single audit. So next, we are going to cover some GASB updates. There were a couple GASBs already effective June 30, 2024. That was Statement 99 related to financial guarantees and classification of derivatives, and also Statement 100, accounting changes and error corrections. Two significant statements that will be effective June 30, 2025. Statement 101, compensated absences, that's kind of a big one. And then Statement 102, certain risk disclosures. We will be focusing on the statements effective in 2025, but we will briefly cover 99 and 100 as well. However, first, Kiva, please launch the next polling question.
Thank you, Hilary. And after you respond to the poll, I would like to ask our audience members to hit the F5 key to refresh your console, or Command plus R on a Mac. We did have a slight glitch, and we'd like to get everybody's console back on track. This is the third of 4 polling questions. The question is, have you been impacted by any new GASB statements this year? A, yes, Statement 99 or 101. B, yes, early adopters, go us. C, no. D, not applicable, what is GASB? I'll give everybody a few moments here to answer. For those of you who would like to receive a copy of today's slide deck, you can download it from the folder that says Slide Deck and Handouts. We'll be also sending the slides via email after the webcast. Okay, final moments to respond. And here are the results.
Okay, so sorry to the 66% that the GASB statements may not affect or impact you. However, we are going to go ahead and move forward with covering Statement 99. So Statement 99, as I mentioned, is related to financial guarantees and classification of derivatives. This was effective June 30, 2024. This establishes or amends accounting and financial reporting requirements for specific issues related to financial guarantees, derivative instruments, leases, public-public and public-private partnerships, BIDA or subscription-based information technology arrangements, the transition from LIBOR, certain supplemental nutrition assistance programs, non-monetary transactions, pledges of future revenues, and then a focus on government-wide financial statements and terminology. Other derivative instrument-specific changes are that the changes in the fair value should be reported on the flows statement separately from investment revenues. The disclosure should be distinguished from hedging derivative instruments and investment derivative instruments. Disclosures should include the fair value of derivative instruments that were reclassified from hedging derivative instruments. And lastly, if hedging derivative instruments cease to be effective, the balance of the deferral should be reported on the flow statement separately from investment revenues. GASB statement number 100, accounting changes and corrections. This is effective 6/30/24, 9/30/24, and then 12/31/2024. So there may be a few of you that still need to adopt this for 12/31 year ends. This standard made a few updates from the existing guidance that was brought over from FASB. In terms of reporting, changes in accounting principles will follow the transition guidance contained in new standards, or if the changes related to existing guidance should be reported as a restatement to prior periods presented if practicable. Similar to existing guidance today, changes in accounting estimates are reported prospectively by recognizing the change in the current year flow. For changes to the reporting entity, these are reported by adjusting the beginning of period balances, the beginning of period net position, fund balances, etc. And finally, changes that are a result of a correction of error are reported as a restatement to prior periods presented. So overall, this standard did not result in any significant change to existing practice, but it did provide some further clarity on some certain situations. Statement 100 also includes presentation and disclosure requirements. In regards to presentation, the aggregate amount of adjustments and or restatements made to beginning balances for each reporting unit should be displayed in the financial statements. Additionally, the notes to the financial statement should include information about the nature of the change or error, reasons for any change in accounting principles or estimates, and utilize a tabular format to show how changes impact beginning amounts. Again, the disclosure requirements are fairly similar to the existing requirements today. Moving into GASB Statement 101, compensated absences, we're going to spend a few more minutes on this standard. It's going to probably have the most significant impact on the most organizations. If you think that this statement isn't going to impact you, I would encourage you to go back and read through it and make sure that that is the case. So this is effective for fiscal years ended 12/31/24 and then 6/30 and 9/30/2025. So this new standard requires that liabilities for compensated absences be recognized for leave that has not been used, such as cash payments when the leave is used for time off, or other cash payments such as payment for unused leave upon termination of employment. Needs to be recognized for leave that has not leave that has been used but not yet paid in cash, such as a non-cash settlement or a conversion to post-employment benefits. Some examples include vacation and sick leave, PTO, paid time off, holidays, parental leave, and certain types of sabbatical leave. The liability is recognized when the leave is attributable to services already rendered, meaning the employee has performed the services required to earn the leave. It accumulates, can be used for time off or otherwise paid or settled in a future period. It can be carried forward from reporting period when earned to a future reporting period when it'll be used or otherwise paid or settled. And lastly, is more likely than not to be used for time off or otherwise paid in cash or settled through non-cash means, and means has more than a 50% likelihood of being used. So the recognition of leave not used, here are some exceptions. Leave more likely than not to be settled through conversion to a defined benefit post-employment benefit is excluded, as that would be covered under your OPEB or post-employment benefits liability. Leave that is dependent upon the occurrence of a sporadic event that affects a relatively small proportion of employees in any particular reporting period. You would recognize that liability when that leave commences. Examples include parental leave, military leave, jury duty. This does not include sick leave or sabbatical leave. Again, these are items that you really can't predict. You have no idea when or how many people it would impact, so that is excluded. And then unlimited leave and holiday leave taken on specific dates. Again, you would recognize that liability when used. The standard also establishes guidance for measuring the liability for leave that has not been used by generally using an employee's pay rate as of the date of the assignment. There is an exception, more likely than not, to be paid at a different rate, and you would use that different rate. But for most situations, you would use the pay rate as of the date of the financial statement. A liability for leave that has been used but not yet paid or settled should be measured at the amount of the cash payment or non-cash settlement to be made. Certain salary-related payments that are directly and incrementally related with payments for leave also should be included in the measurement of liabilities. So think of your employer share of taxes, required contributions to certain retirement plans. So this really expands the scope of this. It's not just your direct compensation. It's going to be all the indirect items that are potentially related to those salary-related payments. On the plus side, there is no new disclosure requirements related to this standard, related to the standard. And in fact, GASB is allowing for changes in these long-term liabilities to be presented net, as long as there is an indication that it is at a net amount. So the biggest impact this standard is expected to have is related to governments that have more traditional sick leave policies that were only accrued for based on expected termination payments. Now these plans will be required to accrue for any balances of sick leave that are expected to be used in a future period. A few other considerations. In terms of impact, this is one of those standards that really does require careful consideration. In some cases, governments may be recording some liability and therefore presume they are good, but a very careful review of each leave program is going to be needed. As I mentioned at the start, if you think this isn't going to impact you, I encourage you to sit back down and read through the standard and make sure that is still an appropriate conclusion. Sick leave programs in particular may be impacted and are going to require careful review. Although sick leave may not be paid out at termination, in reality, sick leave is earned and is expected to be used in a future period while employed. Therefore, there is some amount of a liability that would be required to be recognized, and this is going to take significant judgment to determine and can be dictated by state laws or collective bargain agreements. I know another area is going through all of your policies to ensure that you are considering all types of leave programs available to employees and making sure that you're really considering all of those when looking at this standard. As with all accounting standards, both governments and auditors will have to consider materiality. As we recently learned from other standards like the lease standard, what may not be a material liability today could grow into a more significant liability over time. And with all estimates, these liabilities and major assumptions used in them will need to be periodically reevaluated. Moving along to GASB 102 is a disclosure-only update that is focused on identifying concentrations or constraints with the government and assessing whether the government is vulnerable to the risk of a substantial impact related to the concentration or constraint. If certain criteria are met, the government would have to include disclosures related to these risks. So although GASB 102 is primarily a disclosure-only update, it does require governments to assess if they have known concentrations or constraints. A concentration may be a bit more easy to identify, as it is a lack of diversity related to an aspect of significant inflow or outflow of resources. So think of a concentration of revenue from one source, or tax revenue are concentrated from one employer. A constraint, on the other hand, is a limitation imposed by an external party or through formal action by a government's ultimate authority. This includes things like limitation of debt issuance or state laws limiting ability to raise taxes. Under GASB 102, if a concentration or constraint is identified that makes the government vulnerable to a risk of substantial impact, then you need to assess if events that may have substantial impact have occurred, have begun to occur, or are more likely than not to occur within 12 months of the date of the financial statements which be issued, and consider appropriate disclosure. The disclosures required would include information about the concentration or constraint, the event associated with that, and actions being taken to mitigate the risk. Standard is going to require, yet again, quite a bit of judgment on everyone's part, and depending on the issue and issues identified, could potentially include some sensitive items. We would highly encourage governments to start thinking today about listing out things that could meet the definitions of concentrations and constraints, and consider these items already discussed. Are they in other places in your financial statement? What types of events could have substantial impact on these, and what processes do you have in place to identify these events timely? That's always a tricky one. So the sooner you can start thinking through that, the more, the more ready you would be to adopt this particular standard. GASB 103 is Financial Reporting Model Improvement. This was just issued in May, and it is the long-awaited final standard related to financial reporting model improvement. This actually ended up being a very scaled-down version from the original exposure draft, and it impacts several areas. We could probably have spent the entire hour today just on this one standard. So this is going to be a lot of information in short bursts, but hopefully you can gather at least one little nugget of information here. So the first area is the MD&A, the Management Discussion and Analysis. The updates in this standard do not really change any of the current content of that MD&A, but it's attempting to articulate to preparers the need to make the information useful by focusing less on what changed to explaining why it changed. At times, the MD&A may feel a little boilerplate, so really trying to move away from that and get back to having a really good impact on the users of the financial statement. The second area is proprietary fund presentation. This is the other area that has the biggest change as it relates to the presentation of the proprietary fund statement of revenues, expenses, and changes in net position. Operating revenues essentially defined after removing items that meet updated definitions for subsidies and non-operating. So you kind of start at the end, take everything else that's considered non-operating, and then that defines what is operating. Subsidies include resources received from or provided to another party or fund for which the proprietary fund does not provide goods or services, and are typically considered to either lower the fund charges and fees, or are recoverable through the fund's fees and charges. So again, think of general tax revenues like property tax or sales tax that may be received. And this also includes all transfers. All identified subsidies are required to be presented right after the operating income loss section of the statement. And then operating revenues are identified by looking at other inflows and removing those that clearly belong in subsidies or other non-operating revenues and expenses. Overall, the impact of these changes may vary, but for everyone, the structure and word of the statement will need to be updated. And since this will require retroactive information, means governments need to start thinking now about what items may need to move to these new classifications and start considering what effort may be needed to update the form and content of this statement. The next area is unusual and infrequent items. Statement 62 defines terms unusual in nature and infrequency of occurrence, which is still how they are defined. Any items identified as unusual or infrequent should be presented as inflows and outflows as the last item prior to net change in resource flows in government-wide, governmental fund, and proprietary fund statements. They should be presented separately and not netted, and should include disclosure regarding these items in the notes. Operating and non-operating revenues and expenses. We just discussed that above with the proprietary fund discussion. Essentially, there's new definitions for what's operating and non-operating. The second to last area is the budgetary comparison information. This should be presented as required supplementary information for the general fund and each major special revenue fund that has a legally adopted annual budget. Separate columns for the variances between original and final budget amounts and final budget amounts and actual results are required to be presented. And an explanation of significant variances between these columns should be presented as notes to the required supplementary information. The last major impact of this statement is for major component units. You should report each major component unit separately in statements if it does not reduce the readability of the statement. If it impacts readability, then combining statements of major component units should be included in the basic financial statements after the fund financial statement. And now we're going to shift topics quite a bit here, and we're going to talk about cybersecurity. This is an area that everyone should be thinking about and considering. We are continuing to see increased issues with cybersecurity, attacks, and threats. So we are going to walk through a few topics. So first, a couple definitions. So a security incident or event versus a cybersecurity breach. A security incident or event is a precursor to a breach. It's any activity that compromises the security, confidentiality, or availability of a system, and it could have a low, moderate, or high severity level. A security breach, on the other hand, is the unauthorized access, disclosure, or acquisition of sensitive information or confidential information by an individual, group, or organization. An incident that results in the confirmed disclosure, not just potential exposure of data, and typically it's a critical severity level. The current state of cybersecurity, this is a pie graph of the attack types in 2023. The biggest piece of the pie, 35%, is phishing and BEC, which is business email compromise, followed by ransomware at 20%, insider threats 15%, supply chain issues 12%, and other 18%. I also found this statistic interesting, I guess. 70% of CEOs are concerned about their organization's ability to avert or minimize damage to the business from a cyber attack. So let's talk about a few of these identified risks. So the first one is phishing. Phishing is an email that requests sensitive information in the hope that an insider will inadvertently provide it. Usually a sophisticated attack, and it usually involves social engineering that's going to prey on the psychological willingness of employees to divulge certain information. These attacks involve an email from a malicious actor who appears to be an individual or well-known business, so not easily identified as someone who isn't an authorized user. And the target tends to be unaware the target tends to be an unaware or an untrained employee who may be more willing to give up desirable information such as password or company account details. So they do try to go after people who are more likely to provide the information that they are after. And before we move on, we will move into our last polling question.
Thank you, Hilary. This is our final polling question. Has your organization experienced a cybersecurity breach? A, yes, within the last 2 to 5 years. B, yes, this year. C, no. D, we aren't sure. Once you have completed all CPE requirements, you'll be able to download a PDF of your CPE certificate from the CPE progress window. We'll leave this up here for a few more moments. Okay, here are the results.
Okay, so congratulations to 60% of you. Happy to hear you have not seen any sort of cybersecurity breach. But there's obviously a lot also joining that have seen breaches, and I think the risk is obviously still out there, and hopefully, again, you can learn some safeguards and some other information today that can help continue to keep you out of the no cybersecurity breaches. So business email compromise, again, this is one of the biggest pieces on that pie graph related to attacks in 2023. So types of business email compromise, some of the standard ones that we see are false invoice schemes, where a fake invoice is made that looks very real, submitted for payment, account compromise, meaning banking information is given up or passwords are passed along, attorney impersonation, data theft, and CEO fraud. That CEO fraud is, again, a very common one where we see someone pretending to be the CEO and sending an email to wire a large sum of money or write a check. The person gets it, assumes it's the CEO, and performs those steps and ends up giving money out inappropriately. What we always try to say there is, make sure that you're doing some sort of in-person connection to make sure that that person truly did send that email. Make sure you have policies and procedures that maybe say, hey, the CEO would never email you this request. It needs to go through these types of controls and processes, because that would allow someone to know, oh, that's a little weird that he's sending an email. Maybe I shouldn't move forward with this. The next area is ransomware, which is a type of malware that attempts to extort money from a user by infecting and taking control of the victim's machine or the files and documents stored on it. The first bullet point, a little shocking and scary, that ransomware attacks occur on a business every 11 seconds. So typically your organization's firewall or other controls are in place to keep those from coming in, but every 11 seconds they are occurring. Organizations have experienced significant business impact, so it's not just the cost to get your information back, it's the number of days and disruption to your business. As you can see, the last bullet point, most organizations take 2 to 4 weeks to fully recover. So it's something to think about too, is that it's not just the payment to get your information back, but it's the ripple effect of the impact of having to close down business or shut down certain systems that can really disrupt your day-to-day operations. 80% of those who paid a ransom experienced another attack. So even if you pay, you are not safe from the future. And then 46% regained access to their data following payment, but some or all of the data was corrupted. So ransomware is definitely a big issue. So some cybersecurity best practices. That circular graph really shows the different layers that you need in place to really protect that data that's at the core center. So you've got your perimeter, your workstations, your network infrastructure, your critical servers, and then your data. So defense in depth is a layered approach to information security focused on fundamentals. Zero trust leverages defense in depth but refuses to trust users and devices. So it's just that really strong firewall or other control. And then multiple controls are in place to defend against type of attacks or failures, such as, and you'll see a variety of those listed there, firewalls, endpoint security, regular patching, etc. So 10 things you can do to combat threats. I know for a lot of small I know a lot of small organizations don't have necessarily the funds to implement all of these items, but I think there are some low-hanging fruit on this list that can be implemented that would really help keep you and your organization safe. There are also always third-party services out there that can assist in implementing some or all best practices. So the first one is take inventory of all information assets and perform a risk assessment. That perform a risk assessment is the most baseline that can be done to see where are we most vulnerable. Perform hardening, such as change default usernames, strong passwords on systems, and apply minimum level of access to data. So performing an access review annually or semi-annually on who does have access to the system. We see a lot of times passwords are still maybe not at the most complex level that we would want to see. So changing your password policy is a great way to improve controls there. Update device definitions and patches so that all of your system software and your firewalls and your antivirus are up to date. Use multi-factor authentication. I think that's true about almost everything I log into these days. There's almost always some sort of multi-factor. Develop a robust third-party vendor management review program. If you have third parties that you use, remember that they also need to have the controls in place to help prevent any cybersecurity breaches. So just because it's with a third party doesn't necessarily mean that you are safe. Conduct frequent security assessments and test your response and recover plans to make sure something does happen, you can get back up and running again quickly. Conduct frequent security and social engineering awareness training with your employees. Maintain appropriate cybersecurity insurance. I know this has been a hot topic lately of trying to get that cybersecurity insurance. Implement real-time monitoring services. Again, I keep mentioning firewall, but firewall and server event logging to see if there are incidences that are occurring and again, implementing controls to keep those from getting through. And then lastly, maintaining secure offline backups and then test the viability of resources. And with that wraps up our presentation. I'm going to pass it back over to Kiva.
Thank you so much, Hilary. It looks like we do have a few minutes here for a Q&A. I will read off the question here. Can you please clarify whether government grants receivables are on the outside the scope of ASC 606 are subject to the new CECL rules? Are these considered excluded like how pledges are excluded?
That's a great question. So yes, government grant receivables are out of scope from the CECL standard. So technically, CECL applies to financial assets that are subject to credit risk, such as those that we discussed, loans receivable, trades receivables, and debt securities. However, government grants and other type of grants are generally not considered to involve credit risk in the same way as other financial assets like loans. And this is because government grants are often non-repayable or subject to other specific terms that do not create an expectation of credit loss in the traditional sense.
Okay, great. Another question here. How does CECL work with programmatic loans receivable?
Another good question. So for CECL, those programmatic loans receivable are typically considered the same as any other loans receivable. those company or those organizations must estimate expected credit losses over the life of the asset, rather than waiting for a loss to be incurred. So you will need to consider the forecast and reasonable information related to the term of those specific loans, in order to revisit if there is any allowance or credit losses to be considered on those specific loans, programmatic loans receivables.
Perfect. Thank you so very much. One more here. How does the equipment threshold impact? Do we need to return the equipment even if it's less than $10,000?
Okay, so when we were talking about those new updated thresholds, that equipment threshold that increased from $5,000, which is the current threshold that we have right now, those are applicable for capitalization purposes in accordance to the uniform guidance. So the uniform guidance would say the threshold for equipment is typically $5,000. This means that if an individual item of tangible personal property has a value of $5,000 or more, it should be capitalized and treated as equipment in the organization's financial statements. And then if the item is below the threshold, like again, like in this example, $5,000, because that's what the current compliance supplement shows, it might be considered as a supply or any other smaller asset and generally not capitalized.
And we have time for just one more here. How do threshold amounts compare state versus federal?
Awesome. So while federal thresholds for all the things that we discussed, equipment, procurement, and audit requirements are generally standardized under that uniform guidance, the state thresholds can vary widely based on state-specific regulations and those terms of individual state grant agreements. So state auditors and compliance officers will assess adherence to these state-specific thresholds in addition to the federal requirements during a single audit. And I would say one more thing here. Organizations receiving both state and federal funds must ensure that they comply with both sets of thresholds and reporting requirements in order to avoid any audit findings or compliance issues. So very important to take care of both.
Thank you so much. And thank you both, Hilary and Etty, for a great presentation today. If we didn't have time to answer your questions, we will do our best to follow up with you following the webcast. Also, feel free to reach out to our presenters if you have any additional questions. We invite you to visit our website for more resources and information on any of the topics discussed today, many of which are linked in our handouts window. Please be sure to join us next week for our webcast, Strategic Co-Sourcing of Internal Audits in Higher Education, on Tuesday, November 19th. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy of your CPE certificate will be emailed you within 3 weeks, should you have any difficulty downloading it now. Finally, here's a link to today's survey for our presentation. Your feedback is always appreciated. Again, thank you for joining us and take care, everybody.